The main five topics of our presentation is the fact that we are into extra time, the fact that capital gravity in terms of capital flows is changing all the time. There's an increasing focus on reinvention of assets as investors search for value add strategies to unlock yield, and also a trend towards no ownership of assets, which is causing a whole new asset class to emerge, which we think will substantially alter the investment field over the next 15 to 20 years. So moving on to extra time, many major economies are experiencing prolonged economic cycles, raising the question of whether another global recession is on the horizon. It's probably too early to tell, but real estate investors should strategize appropriately, exercising caution when seeking out future opportunities. So looking at where we are in terms of economic cycles extending, we can see that we're in record long economic growth in many markets, most of which is the US and Australia, which is at 108 quarters of uninterrupted economic growth. While this economic growth is carrying on, we're seeing that there's a big drop in the level of GDP growth. You can see across all sectors and areas we've seen GDP growth by decade falling substantially. So we're in an elongated cycle, but with much lower growth. Coming on to interest rates, we're seeing that we're at record lows all around the world. You can see from this chart that 10-year government bond yields in all the major economies of US, UK, Germany, Japan, Australia have all hit record lows, which is having a profound impact on the investment market globally. And those 10-year government bond yields, we've seen a big change over the past year, substantially in major markets like Australia, where we've seen over 140 bips of drop in terms of the government bond yields, but also the US, UK, Singapore, and Japan, substantial drops in the government bond yields, which is going to impact the investment market substantially. So what does that mean for capital gravity? There remains a strong argument for people putting money into real estate, but the money is going to change as to where it's coming from and where it's going to. Allocations to retail are falling, and allocations to industrial are growing substantially. In terms of global investment volumes, we've seen that we actually had a record year last year, and global investment volumes stood at over 427 billion, still above the long-term average of 350 billion. When we look at this in Asia Pacific on the next slide, you can see that there's been a big turnaround in where the money was going to and where it was coming from. We've seen both the Americas and EMEA seeing year-on-year volume declines. However, Asia Pacific has delivered gains of about 14% year-on-year. Much of this result is due to a surge of activity in China, which was up 105%. We've seen a limited window of buying opportunities in China as many companies deleverage in that space. A lot of the US and Singaporean investors have been very active acquiring assets, particularly focused on the domestic Chinese markets with exposure to e-commerce and core office. The Brookfield buying the Hongkou Center from Greenland is a good example of that. Singapore has also performed really well, up about 71%. And we're seeing a lot of Singaporean investors taking gains in Singapore and putting money into alternative sectors in developed markets, particularly into student accommodation in the US and UK. Overall, we're expecting transaction volumes in Asia Pacific to buck the global trend and deliver an extra 5 to 10% on what we saw in 2019. In terms of the amount of cross-border capital, we're seeing it volumes at 31%. It's actually a global record in terms of the globalization of investors, and we expect that trend to continue. And looking at the source of cross-border capital into Asia Pacific, there's been a notable pickup in activity from US investors, as primarily driven by a large pool of capital being raised by global PE funds. And we're also seeing a big increase in Singaporean investors within Asia Pacific. So making up 23%, they're now the largest outbound Asian investor taking over from China. Hong Kong-based investors collectively accounted for about 15% of cross-border investment, primarily focused on Japan and Australia. And a big change is the capital flows from China, coming down substantially from 25 billion in 2017 to just 5 billion in 2018. We expect those capital controls to remain in place for the next 2 to 3 years. So along with a rise in investment volumes in Asia Pacific, we've seen a marked increase in the ticket size. You can see from this chart, the challenges with accessing scale for overseas investors that have led to an increase in what we call mega deals, transactions over about 500 million US. So far in 2019, mega deals have accounted for about 25% of all transactions. We expect this trend to continue over the remainder of the year. There's a number of large assets making their way into the market and a lot of liquidity for these assets, particularly in China, Singapore, Australia, and Japan. In terms of private equity funds, we've seen equity fundraising in Asia Pacific has reached a 10-year high in 2018, falling just shy of 20 billion. However, that fundraising has been a lot more concentrated within a smaller number of managers. There's a huge amount of dry powder within the Asia Pacific region, focused with about 40 billion or so left to deploy in Asia Pacific. So there's going to be a lot of pressure on the PE funds to get money out over the next 12 to 18 months. In terms of the focus, we're seeing many core investors are stepping up the risk curve in order to boost returns in this low rate environment, and a big focus on value added properties. So as yields compress, we see there's going to be a lot more focus on asset repositioning and a lot more hard work undertaken in terms of increasing net lettable areas and improving efficiency on assets as yield compression probably moderates and investors have to work a lot harder on the asset management side to gain the returns they need. There's also a growing trend around asset conversion, particularly within the industrial and hospitality and living areas. That brings us on to the reinvention, or the third theme of our active capital report. We've seen a big shift into the fringe. As many of the pricing the CBD is putting a lot of investors to buy in the fringe areas. We've seen huge uplifts in terms of rents in areas like London, Singapore, Paris, and Australia, as the fringe has become a lot more in demand from tech companies, but also getting a lot more investment from investors seeking slightly higher yields. We're also seeing a big increase in the last mile logistics, conversion of shopping centres into urban logistics, food delivery, and e-commerce, and we expect that trend to continue over the next 5 years or so, particularly in the less developed markets in Asia. We've also seen a big increase in the shift into no ownership from end users. So lifelong tenants, there is an argument to say that a lot of tenants will be in rented accommodation from when they're born up until when they die. What we're seeing is from student to multifamily, single family to senior living, more people are rethinking the idea of owning their own property in favor of something more flexible and affordable. So this structural shift is creating a new field of opportunity for investors. So when you look at this life cycle, the investment lasts from student property, in which student numbers globally have hit record levels, to co-living, which offer tenants a much more affordable, compact units and larger shared amenities, to multifamily, which is also a very established class in the US and now growing rapidly in UK and Australia, all the way to healthcare and senior living to cater to the rapidly aging population. And that's reflected in the large increase we've seen in the alternative asset class investment volumes in Asia Pacific, jumping from just over $1 billion in 2009 to up towards $6 billion in 2018. We expect that trend to continue substantially across the markets in Asia Pacific. There's also a big shift into the rising importance of ESG. A lot of investors paying a lot more attention to this area, and we expect that to continue over the next 5 to 10 years. So in terms of the outlook and key themes, we see strong to medium term outlook with an extended cycle largely driven by the lowering of interest rates. The long-term themes supporting the investment cycle, the move into alternative sectors, is showing good thematic investment opportunities within Asia Pacific, and these lower funding costs will underpin the low property yields substantially over the next 3 to 5 years. There's a widening spread to bond yields, and that's probably going to cause cap rate compression, certainly in the office sector and the logistics sector. So that finalizes the presentation on active capital. Thank you for your time.